Welcome to this video where we're going to talk about Netflix and the 30% plunge this morning. Almost 50 billion has been wiped off the value of Netflix. So where is this going? What's happening in the world where something is going to increase in value? If you're new to this channel, by the way, I help you navigate the wall of information that is the stock market to predict outcomes. So first of all, this is what we're talking about. Netflix share price plunges as subscribers fall for the first time in a decade. The value of Netflix has been completely demolished by roughly 30%. It's not just Netflix, it's also the other video companies as well. Disney, Roku, Warner Brothers, they're all down. What we're saying is people are moving away from streaming stuff online at home and they're going elsewhere. The purpose of this video is to find out that elsewhere. We're saying Netflix lost 200,000 subscribers and they were predicting more. So that's pretty bad. That's actually pretty freaking awful. Now, in terms of the streaming wars, this is what we're talking about. Netflix, Hulu, Prime, Disney. And this article is about how it's a zero-sum game. So it's saying if people lose that over here, someone's gone over here. This article is arguing whether is that the case or not. Don't really care about that. What we're saying here is streaming has absolutely exploded from 2007 having just 4 of these to 2021 having more than we can really count or that we need. Now, what we're trying to find out is where is this money going? In this category, we're saying this is what's known as consumer discretionary. So that is consumers make a choice on where they're spending their money. If they're taking their money out of Netflix, it's not just the £8 a month they're not spending, it's also the time they're not watching. What are they doing with that time? They're probably outside, doing something different, spending money on other things. Now, to me, this means consumer discretionary. Let's look at this chart here. So this is things like automobiles, consumer services, retailing, leisure, hotels. So where is this money going? If we look at the bottom of the chart here at retailing, this is from the 11 S&P sectors, by the way, which break down all the companies into all the different categories so you can understand what it is that's going on. So here we're saying retailing. Here we've got merchandising stores, computer and electronic retails, home improvement, which I know we've spoken about before, automotive, home furnishing, that sort of stuff. Now, to me, if people aren't watching Netflix, they're going to be out spending. So to me, retail clothing is the obvious answer. So if I look at the list of retailing stocks here, Adidas, American Eagle, ASOS, Bath & Body Works, Burberry, they're all up for the last 5 days. If you look over the last day or two towards the bottom, they've all kind of increased a little bit. So is that a correlation here? Is something actually happening? If you look at the S&P Retail Index, that is all the retail companies on the S&P 500. This is the index for them. So they're all correlated together to give us this chart here. We're saying over the last month, it's kind of flat. Over the last 5 days, it's kind of up. If we look back at our specialty retailers here, second one down, computer and electronics retail. Are people taking their money out of Netflix and spending it on computer and electronics retail? If we look at these stocks here, the first one that comes up is actually HP. Now, we know that Warren Buffett invested in HP last week or a few weeks ago, quite a significant amount. Is that correlated to Netflix? Are people going to take money out of that and put it into computer parts and home computing? That to me doesn't add up. That doesn't seem like the path we want to follow, our yellow brick road. Instead, however, will people be travelling more? That could be true. That could be a fact that we're looking for. So if we look at airline stocks here, American Airline, Delta, Southwest, United. Look at the stories at the bottom, posted just yesterday. Airline shares are flying high today. This article here talks about that. If I look at American Airline stocks, it's actually the highest it's been since 2021. Now, is that a correlation? That to me sounds accurate. People are watching less TV because they're travelling more, seeing friends, family, business, whatever it is, it doesn't really matter. What else could be going on in this passage of thinking that we're navigating through? We're saying this is happening in the world. Who else is going to benefit from this? And if I scroll down my list of retail, the one I showed you earlier, this is one of the companies that sticks out to me. Decker's Outdoor Corporation, up 9% in the last 5 days, up a bit more over the last 1 or 2, if you can see by the chart on the right-hand side. They make footwear, more higher end, nicer brands, UGG, Kookaburra, Hoka, Teva. These are the boots they make. I'm sure you've seen these before. If we carry on down the list, we got JD Sports. They're more sporty. Lululemon, they're more sporty. And there's this article here. Lululemon aims to double sales to 12.5 billion by 2026, eyeing even bigger men's business. They're trying to target men's business. Is that something we should be looking at? And they've also introduced running shoes for women. So they've introduced running shoes for women, but they plan to double their business through men. That doesn't make any sense to me. Let's just stay away from that company. The share price is up 30% in a month. Okay, there's quite a lot going on there. I think this is one we should touch on in the future. A lot more detail to go into for this company. However, this company, Steve Madden designs and markets shoes and fashion accessories for women, men and children. They're slightly higher end, slightly fashion, not quite up there with, say, Hugo Boss, Prada, more affordable stuff, which is what we want here. If we look at the middle of our list here, Steve Madden Limited, up 9.16%, coincidentally exactly the same as our company, Deckers. But generally you can see there's a pull upward trend in the last day or two in retail. What I did see here was that Steve Madden, from March 2020 to October 2020, during the coronavirus, was completely flat, up 4.85% almost, for March, April, May, June, July, August, September. So for 6 months plus, the share price went nowhere. I assume this is because they don't do delivery, and it wasn't because of the brand itself. But that, again, is something that sticks out, something to look into. That's a path I could follow down, but I won't for now, because this video will go on all day. If you don't know who Steve Madden are, clothes, bags, women's stuff, quite a cool, quite a fun company. But what we're trying to do here is analyse what's happened to the roughly 50 billion that's been wiped out of Netflix. Where is that going? If we summarise it all through our consumer discretionary stocks, what we're looking for is facts. We're looking for factual information that's true that we can make decisions on. We're saying Netflix is 100% down. That's happened. We're saying airlines are up. And then we've got these two companies here, Deckers and Steve Madden. That to me kind of adds up. You can see why people would pull their money out of that, be out doing more things and then move towards those brands because they're slightly higher end than, say, your Ross stores or your low budget stuff. They're personal products as well. They're feel good. They're, okay, I'm doing this, I've got this is what I've done today. And you can see how that correlates to something like Nordstrom. However, Nordstrom is more of a department store. So would people be buying into a brand for themselves or a department store? Now, the question between those two things is how cautious are people? If you go into a department store, you're going to buy more than just one item. It's going to be more of a spend. So that's the question between those two things. There's also this company here, Abercrombie and Fitch, which I kind of fall into the category as well of Deckers and Steve Madden. Again, higher end compared to your Ross stores, fun. So what are we saying here? We're saying number one is do not buy Netflix. Netflix is just don't. There is so much going on in that space. I would stay away from them for at least 6 months, see what they can pull out the bag. Now, following down this yellow brick road, we're saying these two companies here, Deckers and Steve Madden, they could very well perform from what we've come up with. Those are the companies I'm going to keep my eye on. There is more to go into. The company's financials, leadership. So the video, again, could go on all day, so I won't make the video all day. But that is the end of our yellow brick road. And that, to me, is what is going to happen because of what has happened with Netflix down. These two companies will be up in the future. I spoke about retail in one of the first videos I made, the rotation to retail, which is based on a company called Coates Group, who manufacture the threads, the fasteners, zips, things like that retail is made out of. So that is an indicator that retail will be up in the future. Now, if you want to learn more about how I think through this stuff and how I see the stock market, I highly recommend this book here, The Encyclopedia of Human Behaviour. If we look at a quick sample of the chapters here, behavioural economics, behavioural genetics, behavioural medicine, behavioural pharmacology, the behaviour genetics of intelligence, biofeedback therapy, body image. If you're talking about retail and companies like Lululemon, then body image would be pretty important for this kind of stuff. Brain, behaviour and relationships, brainwashing and totalitarian influence. If you're wondering what that is, that comes under the category of free will. Free will is the capacity of agents to choose between different possible courses of action unimpeded. My advice, don't buy Netflix. If you did like this video, please like, subscribe, comment, and I'll see you in the next one.
See the wizard.